guys, welcome to another segment of Freyman CPA. Today I'm going to bring to you a really interesting topic, one that comes up for new business owners quite frequently. We're going to discuss how exactly are those costs that we spend when we're opening our business up for the first time, how they're actually treated for tax purposes. And what you might not realize is that when you're getting your business up and running, the costs are typically put into two columns. You have your startup and then you have your organizational costs. And organizational costs are really costs that happen sometimes even before the business actually exists, before your entity is formed. And a lot of the time it's paid out of pocket. So you're looking at expenses for attorney fees, you're looking at accountants fees, incorporating fees, and so on. Those are organizational costs. And then you have the startup costs. And startup costs can also vary greatly. They can range from anything from paying salaried employees all the way up into building out the lease spaces for the physical space of the business where you're renting or buying, perhaps, what have you, operating costs, and so on. So if you're in business and you just started your operations and you think that all of these costs, and sometimes these costs are quite significant, folks, they can range in the hundreds of thousands of dollars. And if you believe that those costs would be all deductible and you're going to go and have a wonderful tax year, unfortunately, for tax law, that wouldn't be the case. Why? Well, because for two reasons. First of all, these costs are capitalized. And what does capitalization of costs mean for accounting? It basically entails taking the expenses and not deducting them and placing them on the balance sheet. And basically, if you followed our previous YouTubes on profit and loss and financial statements and balance sheets, you'll understand that these are assets. And assets are not up for deduction right away. They're actually deducted under a certain method that is allowed by the tax authorities. And if we're dealing with the federal tax authority, that's the IRS, they have a prescribed method, and you can take a certain amount of it as a deduction, like, let's say, for example, just to keep things simple, $5,000 in the first year, and for startup and organizational costs. And then the rest is basically still capitalized, and it's just going to sit on the books and is going to be amortized. I hate to use the word depreciation when I'm dealing with startup and organizational costs, because they're considered up for amortization. The idea is the same, but the length of time is quite lengthy. You're going to be recouping these costs for many years, 15 years really on the current law. So it's not like you're going to see this anytime. The cost recovery is going to be there. You're going to get your costs back and you will deduct them at one point in time, but it's not going to happen in that first year of operations. You say to yourself, well, great. Well, what about all the build out and everything else? Well, those also will be up for depreciation. I'm not going to go into the details of how things are depreciated. It's a very lengthy topic and very specific. And I've done a video up here. You guys can take a look and see what I mean when I'm discussing depreciation. But just know that you won't be recouping the costs also right away. There's exceptions. But anyway, here's the next topic that I really want to talk about is the pitfall. So, okay, let's say you open up a shop, and let's say it's a retail store, and you start everything in, let's say, September, okay, the month of September. And you start building out, you got your startup costs, you got your organizational costs, but you don't open up the doors for business until February of the next year. What happens? Do you get to deduct anything in that first year of operations? And the answer is no. And why is it no? Because you haven't opened up the doors for business just yet. And if you haven't opened up your doors for business, there's nothing that can be deducted because you haven't started the revenue generating activity. And it's like a matching principle in accounting. You know, we want to match revenues and expenses and time them appropriately. So if you haven't started generating income yet because you're still getting things up and running, then unfortunately those assets are not placed into service, into their intended service. And actually in the software, there's no place to even put that in just yet, because the software is going to ask, what's the date placed into service? And if it's not in service yet, because it's not in it fully finished for its intended use, it can't be physically in service, and hence you have nothing to deduct. You cannot take them, right? Even though they're operational costs and salaries and all these other costs, they're still not in their intended use. So we have to capitalize these costs, and they're going to be deducted at some point in time. So, but again, they're going to be capitalized and deducted a slightly different way. They're not going to be deducted as expense as if it were a regular year of business in your open operations. So if you cannot deduct them as a regular expense the way you normally would under normal conditions, and you can't take them as capitalized assets and depreciate or amortize them, when do you take it? Well, you can only take it when you started generating revenue. And matter of fact, I just came into an article here that actually goes into a few cases, court cases, where the gentleman started his business in like the year 2013, and he put a lot of these costs into momentum, and it took him all the way up until 2019 to deduct these. To not deduct them, but to get really to open up doors for business and start generating revenue. So unfortunately, the IRS pulled him over and basically disallowed all the expenses because he was just literally deducting them every year that he had them. And they won because they didn't, this taxpayer didn't follow the rules and wasn't up and running. So he wasn't eligible to deduct anything, and they footed him a bill, and it went to court, blah, blah. It was a whole mess. But that's basically the premise. So I wanted you guys to understand that when you're opening up business, this is a big pitfall that many people, they bank on it. They're like, oh, wow, I've spent $50,000 getting my business up and running. It's going to be a great year for me. No, it's not. Because if you haven't opened up your doors for business and you're not generating revenue, unfortunately, the tax law says otherwise. Now, the trickier part is that when I give an example of retail business, that's a very specific example, obviously. But in the real world, we have many different examples, and sometimes it's not so straightforward, and we can't really tell where's that dividing line as to, well, we have to figure it out, right? But like if you were to think of other business types, it's not always so cut and dry as a retail business, and we have to do investigation and actually look a little bit further to see when that business is actually eligible to start deducting the costs and capitalizing the costs and whatnot. And that's obviously a conversation to be had with the client and looking into the industry, because every industry is different. And for example, a consultant is different than retail. So if a consultant, didn't start generating revenue in any which way, no matter how much money they've spent polishing themselves up to get ready for consulting, in a consulting endeavor, it won't matter because they haven't started actually trying to generate income. And in their circumstance, there's no physical location, there's no brick and mortar, but what they do is they sell services. And if they haven't tried to go and generate income yet, and all they've been doing is building the repertoire to get to that stage, then it would be almost the same. It's basically the same thing as that brick and mortar. It's just translating in different terms. All right, folks, so I just wanted to bring that up and discuss that with you and just kind of help people out there get a little better understanding of how things work when a business is opening up and what's eligible for deduction, how it's eligible for deduction. Remember, always feel free to reach out and get a consult from a tax professional that deals with a lot of startup work and has experience in both startup and wind down, because that's kind of important that the tax practitioner you're going to find has experience and has guided other clients from pretty much the whole spectrum of business life, from inception all the way down to the solution. It's very important to have somebody that's seen that whole cycle, because there's different parameters, and the insight's going to be of great value to you as a client, because that individual has literally brought people from start to finish in their businesses and has seen the final outcome. And having that insight sometimes can help greatly do a master plan. All right. Anyway, remember here at Freyman CPA, what our motto is your success is our success all day, every day. We hope that you have a great one, that this video has helped you in some way. Do reach out, but if you're finding that you're not getting the answers somewhere else, then that means that you need to dig a little bit further and find the right team for you. All right. Well, thank you so much and have a great day.